Hi, I'm Caleb, and in today's video, I'm going to share with you whether it's worth it to buy a condo for investment, especially for rental income. So I'll also be breaking down all the different costs that you'll be looking to pay if you were to rent out also, and what would it be like if you were to sell it in the next 5 years, and if let's say you were to sell at the same price, will you make money? Okay, let's jump right in right now. Okay, so this is about, is it worth it to buy a condo for rental investment? So let's imagine today we are buying a 1-bedroom condo in the Orchard area, and it costs about 800,000. This is what my client bought about 4 years ago, and it's a 1-bedroom unit, and he take up a 75% loan with a 5% minimum cash and 20% CPF. This is of course no additional buyer's stamp duty, but the typical stamp duty applies and the legal fees applies as well, and the CPF. And you're using CPF to pay for those things, and you're renting out at 2,500 a month. So next is that what are the costs involved when you rent out a property? So you'll be looking at maintenance fee of 250 a month, agent fee of 2,005 times 1.07 divided by 24 months, which is about $111 a month, around there. Property tax about $150 a month, fire insurance about $25 a month. So net rental after minusing everything about $1,963.54. Okay, so let's have some assumptions when we do this calculation, because not everything is fixed. So let's assume that we are paying installment by cash, and there's 100% occupancy rate, and rental stays the same, interest rate stays the same. So let's the question we will be looking at is, will I make money? So will I make money if I were to sell at the same price, and when should I sell it? Should I take a shorter loan tenure? How much will I make if I sell at the same price, and how much will I make if I grow at 3% compounded annual growth rate for 5 years? So let's jump right into the numbers. So this 1-bedroom condo at 800,000 means your loan is 600,000 plus CPF, stamp duty, legal fee about 181,000, cash, the minimum cash of 5%, 40,000. Total we're looking at 821,000. Down payment we're looking at 221,100 already. So this is your fixed capital. Then loan tenure is 30 years, and your interest rate is 1.2%. So monthly installment we should be working out about 1,985. And then monthly rental about 2,005, and so on and so forth. The net rental, like what I mentioned just now, would be 1,963.54. So assume we pay installment by cash, assume 100% occupancy rate, and the two other assumptions. And rental yield we work out to be about 3.75%, which is quite good actually. And if there's no growth, it's at 800,000. If we were to grow it at 3% for 5 years, we'll be looking at 927,419. Okay, so let's jump right in. So let's look at the amortization table first. So this is how your breakdown of principal and interest is going to be. So your 1,985 in the start of the time, 600 will be paid for interest, and 1,385 will be paid for your principal. As you grow along the way, you can see that generally at 25th mark, right, 25th month, which is 2 years mark, you will be paying more towards your principal, and your interest will be going lesser, and eventually your balance loan will be lesser, much more also. So next column will be total installment paid. So basically this is just simply how much you have paid times the number of periods itself. So very simple. And then your monthly rental that you receive, this is the net rental that we'll be receiving. The net rental 1,963, then times the number of months that you have been receiving it by. Okay, then CPF accrued interest, because you have initially used this 181,000 as from CPF, we need to pay interest on to use it. So this is the amount per month. Then sum it all up per year, it's about $4,527. Okay, next we should be looking at accumulated CPF interest. Like what I said, how much interest have you accumulated so far? So this is the amount that you need to pay at the end of 12 months, 4,527 that you need to pay. Okay, so next it's what is new capital going to be? New capital is simply just going to be your old capital that you put down for down payment, plus the monthly installment that you have paid, minus off the monthly rental you have received. So this will form the new capital that of your property purchase price itself. So you'll always be increasing, but not very substantial also. So this will form the comparison between your growth, your income, and also the return on investment. So let's now look at it in a bigger picture. So if let's say right now we sell it at $800,000, which means no growth, how much will we receive at the end of the day? We will receive about 201. Basically, this is minus away the outstanding loan, minus away the accrued interest. We'll be receiving 201,000. So will we make a profit? When we compare this amount and this amount, definitely we will not be making any profit. We'll be making a loss. Okay, but we will be making a loss all the way until the 21 months, the 22nd month, which is about 1 year, 10 months onwards. We'll be starting to make a profit if we will sell it at this price. Of course, this one I didn't include in agent fee and stuff like that, and it's not inclusive of seller stamp duty. Okay, so when we grow down the channel, you can start to see that these amounts are increasing. And let's look at year 3. Year 3, you'll be, if you sell at 800,000, you'll be looking to grow at a return on investment of 7.19%, which is quite decent. But when you look at it at a compound annual growth rate, maybe it's not so brilliant after all, because 2.28 you could have gotten it at much more higher return somewhere else. So the key point, let's look at it right now. It's where does the big money comes from? The big money comes from if you sell it at 927,419. So 927,419 means that we'll be looking at 127,000 capital appreciation. Let's look at it how it will work out. So back to this year 1, if you sell it at 927,419, you'll be making a return on investment, a profit of 107,000, which is very good actually. So let's look at it at year 3 as well. Year 3 is also, you're looking at 143,000, which is very good because the compound annual growth rate is about 17%, meaning to say that your initial capital of 221 has grown all the way to 365, meaning helping you to make a gain of 143,000. And when you translate that into the number of months you have put inside, it's about 17.54%, which is very good itself actually. So as we go lower, you can start seeing that the CAGR start dropping. You can start to see CAGR start dropping as we grow into the 5th year also. But of course, no doubt, even if you sell at the same price at the end of the 5th year, your sales proceed that you'll be getting back is a lot higher. That means the profit that you'll be having is a lot higher, but the compound annual growth rate is lesser lah. So at the end of the day, let's answer our questions that we have. So question number 1 is, will I make money? Definitely you will make money. Even if you sell at the same price at the 3rd year mark, 4th year mark. But the question is it a lot? Maybe, maybe not. Not so much to average individual or investors that invest in the US stock market. But if let's say you experience capital growth of 127,000, or even we put at 900,000, it's still good return on investment. Okay, so the whole property game is all about capital appreciation, and you are letting renter to help you wait out this capital appreciation game itself. Okay, so second question, what if I sell at the same price? Yes, if we sell at the same price, we still make money, but only we can sell it after 2nd year, 3rd year to make money itself. Okay, then when should I sell? Of course, if you make capital appreciation, you should start looking to sell somewhere in the 3rd year mark already, because that's where you do not need to pay the seller stamp duty, and that's when your CAGR is one of the highest. So you want to sell it so that you can reinvest the money into some other properties or some other investment to make more money at the end of the day. Then next question, should I take a shorter loan tenure? Okay, let's look at it in the 37-month period. You look at 143,000. If you take a shorter loan tenure of 20 years, okay, just now it's 143, 37, there's not much difference also. Okay, let's look at it at another number, 49 years, 49 months, 156.5, and this is 29.15. 30 years, you'll be experiencing lesser capital gain, but the difference is not very significant. It's about 1,000 only, not much. So I would say, should I take a shorter loan tenure? Maybe, maybe not. But if it's for me, I would definitely have a much more longer loan tenure so that my monthly installment is lower. So that in case of emergency, I do not need to pay so much monthly installment also. Okay, how much will I make if I sell at the same price? Yeah, this one I would also have answered the same question already. If I were to sell at the same price of the third year, we will be making only 15,000. But if we go even longer, we'll be making at $52,000. Okay, at the end of this is end of 6 years, 7 years like that. Okay, and if let's say I make, how much will I make if I grow at 3% compounded annual growth rate for 5 years? 3% annual growth rate will be looking at 927. So meaning to say that we at the end of third year we're making 143, 155, 167,000, which is quite substantial money lah, I would say. But I would say the main bulk, like what you see here, comes from the capital appreciation. You can see the capital appreciation is about 127,000. Then the money that comes from rental is about 28,000 only. So the whole capital, the whole game of property is really about buying, waiting, and selling. And when you sell, make sure you sell at a profit. Okay. One bonus question that some of my friends ask me: what if I pay ABSD? Okay, let's see what if I pay ABSD. If I pay ABSD, means that my CPF will be a lot higher. Plus 800,000 times 0.12. So my down payment will be significantly higher already. 317,100. 317,100. I'll be making a loss all the way. If I sell at 800,000, I'll definitely be making a loss. Okay. But what if I were to look at 927? If I look at 927, I'll still be making a profit definitely. But at the end of third year, instead of just now the 147,000, I will only be making 39,000. So my gains, just now I was talking about 17% gain, will definitely be eaten up by the ABSD that I'll be paying. Okay, so basically, if you want to do so, I wouldn't suggest paying ABSD to invest at the end of the day, because by the numbers that I mentioned, from what I see here lah, basically back to 37 years, I'll be earning 143,000, 17.54%. So basically, what is the lessons that I learned from all this is that capital appreciation is the name of the game in terms of property appreciation. So quicker sale will also allow for higher compounded annual growth rate, which is the CAGR. So if you can sell at the third year, fourth year, go ahead and sell already. If let's say you make a gain of 100,000 or 120,000, you can consider selling already. Then keep your expenses low by reducing your interest amount as well. Then opt for longer loan tenure to help you increase your return also. Even though you don't see much returns, but I would say generally the amount of monthly installment will be much more comfortable if you opt for a longer loan tenure as well. Especially if you are going to sell it for 3 years, 5 years, you want to pay as little as possible and get as much as possible. And with that, do help me to subscribe and like this channel if it's really helpful for you. Once again, I'm Caleb. See you soon. Goodbye.